Hi, Matt McAleer, Director of Equity Strategies, Cumberland Advisors, August 27th, as we move through the dog days of summer. A lot of ways to make money in the equity markets this week. Small, mid, large, all had a bid. Growth a little stronger than value, but value did hang in there. This was in the face of some awful news Thursday out of Afghanistan. And it will be interesting to see how that affects confidence going forward. Remember, equity markets and fixed income markets run on confidence. The confidence that what you buy today or own today can be sold in the future at a higher price. Confidence is what gives you the ability to plan and allocate for that higher price. Have to think from a trading and investment standpoint, the confidence in some of our strategic and tactical planning in Washington has taken a hit. It was a huge blow on Thursday. Today, Chairman Powell was out with some commentary that the Fed is going to remain patient. It's going to continue to watch versus act. And this gave the equity markets a little bit of room, a little bit of breathing room in terms of the Fed quickly taking their foot off the liquidity pedal. We'll see what happens over the next 2-3 months. That'll be an event that we'll need to keep an eye on. I put a slide up today. We're almost through 8 months of the year, and we like to visit some of these slides every now and then, whether it's broad asset classes or equity only global or sectors and industries versus a benchmark. Thought it was interesting to take a look at globally what's been happening not only this year but looking back. It's been consistent. As you know, I've put these up in the past. We pick on international a little bit, we pick on emerging markets, we pick on developed markets versus the S&P, and to some extent that continues. That rightfully so continues to be the case. If you look at the overall performance, and this is price only, not including dividends, price only. If you look at the overall performance since 2013, and by the way, we use 2013 because in 2012 is when the frontier market, FM, was introduced, and therefore we're able to get a little broader look into the international markets. But you can see over that span, the S&P 500 has just been dominant. I know we talk about a reversion to the mean, and when will flat value in terms of PE value matter again internationally, and so far it does not. We don't know that it will in the future. I think one of the things you battle as a portfolio manager or a trader is making decisions that you get stuck in concrete on. We use all types of terms in trading and in the trading room, but the types of decisions that get you carried out in a box. And those are the kind of decisions that you get involved in that you can't pull up from. And we've heard an awful lot about emerging markets, emerging markets, emerging markets. Emerging markets get you fired in this business. Now, will that change sooner or later? It may. But I have conversations continually with not only clients, but observers, friends, that keep on that emerging market hammer. They're cheap, the growth rate, that's where the next 30 years is. That may be so, but until we start to see it, I think we have to be reserved in pushing capital into that area. So in our international, we are heavier on developed. We've had nice performance out of Europe, nice performance out of Canada. In the emerging area, we have had a solid bid out of Taiwan, but as I've said in the past, emerging markets will go as far as China goes in the long run. And China is having its problems, some self-made, some global. We'll see what happens there. But an interesting peek at the last few years of broad global equity performance. Have a great weekend. We're heading into Labor Day week. May see trading taper off a little bit next week, especially towards the end. We'll keep you informed. And Shaun Burgess has a nice overview of fixed income this week.
Shaun Burgess here, portfolio manager and fixed income analyst, sitting in for John Rousseau, who's taking a well-deserved day off today. It was a busy week with treasuries responding to a number of events, including Pfizer receiving FDA approval for its COVID-19 vaccine. Fortunately, terrorist events which disrupted the continued evacuation of U.S. citizens and our allies from Afghanistan, and comments by Jerome Powell just this morning out of Jackson Hole. Comments which the market largely responded favorably to, as treasuries were green on the day. Now for the week, the 2-year ended up lower in yield. The 10 and the 30-year each ended up higher in yield. So what we saw in the week was a steepening of the curve or a reversal of the flattening we saw coming into the week. As I said, the market largely liked Jerome Powell's comments, especially as it related to future rate hikes. It was largely seen as dovish because he was careful to differentiate tapering from a rate hike. He did point out that the central bank would be or is likely to begin reducing its monthly bond purchases. So the Fed is going to taper at some point in the very short term. But he was careful to differentiate, as I said, that from a rate hike. As he said, the reduction in asset purchases is not intended to be seen as a signal on rate hikes. Any rate hikes are going to be largely data dependent. In their words, they're going to be carefully assessing incoming data and the evolving risks. So tapering will be in the short term will occur, but the Fed's not taking the punch bowl away from the party, and they're not going to begin hiking until the data leads them to believe that's the best course of action. So they're going to be largely data dependent, and rate hikes are going to be at some point in the future, assuming or barring a new variant or global event doesn't derail the broader economy and prohibit those hikes. As I said, the market generally liked this commentary. On the muni side of things, munis ended up slightly cheaper on the week, largely underperformed treasuries. We view this as an opportunity. So as we're still maintaining a defensive posture in lieu of our broader outlook for interest rates moving higher in the future, we are going to look to be opportunistic in here and take advantage of any cheapness that we see on the muni side of things. We think it could be a good opportunity to put capital to work, to pick up higher incremental yields in the face of some weakness. We don't expect that to be substantial in any way, but any weakness we're going to look to take advantage of. Now, next week should be largely uneventful. You're heading into Labor Day weekend, and those are generally weeks which, as I said, tend to be very quiet. Issuance is very low. Toward the latter part of the week, people don't tend to be in the office. So next week, we're expecting to be fairly quiet, but if we do see any opportunities, we're going to take advantage of those while still maintaining, as I said, our defensive posture in light of our broader outlook for interest rates to move higher over time. Everyone stay safe, be well, and we look forward to talking next week. Thanks.